Hi, today I'm going to talk to you about why debt financing is better and cheaper in the long run than equity financing. I'm going to also talk to you about an actual case study where a company was able to retain $10.6 million more when they sold out after 5 years in the business. I'm going to talk to you today about a couple of deals that we've done at Dynamic Funding, as well as some deals that I was able to arrange for both equipment financing and working capital. My name is Scott Jordan. I am Director of Business Development with Dynamic Funding, and I'm very excited today to talk to you about how do you go about obtaining the money you need in order to expand your business.
So the very first question is where do you find the money for your business? How do you grow it today? Do you give up more equity? Do you look at creating a convertible note, which is basically giving up equity in the end? Do you look at loans and leases? I'm here to talk to you about loans and leases and what we've been able to arrange over the last year, which is funding $6 million in this business. So why is debt better than equity? There's a few reasons. Number one, with equity, you give up control. Actually, a good friend of mine told me debt is sort of like dating. Equity is like a marriage. And a bad marriage is no fun to be in. Those of you that have been in one know what I'm talking about. Debt, you go ahead and you initiate a loan, you pay on it, it's over, it's relatively short term, and then if you like it, just like a date, you go out on a second date and you do it again. Then maybe you spend a weekend together. That's what I'm proposing here, is to talk about why debt is better. It's much faster to get an answer. In our company, you give me documents that I need, 3 or 4 days, I have an answer. Generally, you can have a check a week after that. So it's very, very quick. Also, you're not having to prepare an offering memorandum. You're not having to prepare an S1. You simply bring me the documents that I asked you for, and we give you an answer. It's also less expensive initially because you're not spending that money on an offering, and you're not also having to find people to go out and present to. And depending on how you're set up, the payment also may be tax deductible. So when does it make sense to use a debt rather than equity? Because debt is not right for every single situation. It's right when you have existing cash flow and you're profitable or close to being profitable. You need to be doing at least $1 million or so a year in revenue, or more. More is better. And have a credit score of at least 660 or better. Debt providers are looking for good credit scores because we need to be repaid. There's not enough margin in us, in our product, for us to be able to afford bad debt. So, if I cracked open a lender's brain, here's what would be inside, and here's a little bit about how we think. We first look for results. We like numbers. What we like to see is we like to see a high credit score. A high credit score indicates good character. And good character means when you sign that mortgage, when you signed on the dotted line, you made your repayment. And that's what we want. We want to get repaid because we want a second date, okay? We don't want this to be one and done. We want this to be the beginning of a relationship. We also want to see your capacity to be able to repay. Your capacity to repay is going to be based on the cash flow through the business. That's your profit and loss statement, your bank statements hopefully, or your POS system. We want to know that you have the ability to make that payment from the existing cash flow if nothing changes. If things get better, as most people say they will in the future once they get our money, fantastic. Gives us a wider cushion. But we don't want the payment to help you make your mortgage payment or your credit card payment next month. We also love to see collateral. Having collateral makes us feel comfortable that in a tight situation you can refinance that collateral. We don't want to take it from you. We want you to refinance and simply continue to make your payments. Again, we don't want this to be your last dollar. So let me give you an idea of how a lender thinks in terms of the risk factors. What we see is, in this industry, it's a brand new unknown industry. We don't have a lot of history. 5 years, 6 years is about the most, and things completely changed in Colorado once we had adult use. So we don't have a lot of history. We've got a very unfriendly government. Those of you that are in the business know 280E is just a real ridiculous set of IRS rules, which hopefully Steve D'Angelo and his crew are going to be able to get changed. But it really changes the face of things. You've got banking issues. The only banks are the ones that are staying underground. The banks that are taking deposits are doing it quietly. And we're certainly hoping that we're going to see Fourth Corner be able to break through and be able to actually be able to come above board and be able to offer deposits, because we like to see that all the money that you're getting gets deposited into your account. Rule changes. Every week it seems like the Colorado Med comes out with a new set of rules and a new way to make it more difficult for marijuana business owners to survive. We got the Eagle 20 now with the pesticide rule. We had packaging a couple of months ago. It's an ever-changing environment, and every time there's change, it makes another wrinkle in a lender's forehead. We don't like that. The other issue is there's no secondary market currently. If we have a bad loan, we can't package it up and sell it off to someone else and get rid of the hot potato. We have to have everything maintained on our balance sheet. So we like short-term loans, short-term relationships. And there's crop risk. Anytime you're growing a crop, no matter what it is, you don't know if there's going to be a problem with it. There might be mites, there might be pesticides. That's a big issue every single month that you harvest. However, there's good news, and that's what I'm here to tell you about right now. Here's the good news. Here's the deals that are getting done. What we were able to do was 9 months ago, we were able to help a company in Colorado, a dispensary with 4 stores, expand to 8. They received licenses in Aurora. They went ahead and they needed a couple $1 million in order to expand out and build out the stores, get the inside furniture, fixtures, and equipment that they need. We arranged a $2 million term loan. We did a short-term loan. It was a 1 year with a 1 year repayment, and the rate was in the high teens. And this was able to save them about $400,000 over their previous lender that had a rate in the mid-30s, which they were happy to pay on a daily repayment. We went ahead and did weekly repayments because we wanted to see what their ability was to make those payments. We also did an equipment financing deal with a company in San Francisco, a cooperative up there, who wanted to go from 10,000 square feet to 25,000 square feet. They needed about $430,000 worth of equipment in order to outfit their grow. They had lights, ballast, tables. Because they had excellent financials and a long-term banking relationship, we were able to arrange a 3-year term lease with a rate in the mid-teens because we had more collateral and we were more comfortable. Now, let's talk about Altria, which is formerly Philip Morris. Altria wanted to get into the vaping business. They bought a company in February last year called Green Smoke. Green Smoke was a 5-year-old company. They were doing about $45 million in revenue. Altria spent $110 million to bring them into the family there. And here's why debt is cheaper than equity. What they were able to do was they had the foresight to know they wanted to get bought out by someone larger. So about 3 years into their relationship, they needed $2 million in order to build out. What they decided to do was they decided to take on some debt. They paid 18% over 2 years, so they had a $360,000 interest cost. They had about $40,000 in fees, so they spent about $400,000 on that debt. With equity, had they taken out that same $2 million, they would have probably given up about 10%. They would have had 0% interest expense along the way. They would have had some expense in order to raise the money. Not sure exactly how much, but we'll leave that at 0 just for the sake of argument. And they sold for $110 million after 5 years of being in the business. So let's take a look at what the numbers look like. The debt cost was $360,000 plus $40,000 in fees for a total of $400,000. The equity cost was 10% of the $110 million, or $11 million. So the difference was they retained $10.6 million more by following the principles that debt is cheaper than equity in the long run. And so when you sell out, you want to consider that. What can you do to bootstrap, to borrow some money? Because even had the sellout been half of that, they still would have come out $5 million ahead. So just in summary, debt is cheaper in the long run, especially when you sell out, and you get to control your own destiny and not be involved in a bad partnership or a bad marriage. Lenders are going to look for the 5 C's. We look for good credit score. We look for character. We look for the capacity to be able to repay and make that payment. We look for cash flow, and we love to have good collateral. So, those of you that think that this is something worthwhile that you would qualify for, please either connect up with me at jordan@dynamicfundinginc.com or hit me up on LinkedIn, or come and see me after the session. Thank you very much.